Happy New Year, and welcome to another edition of Market Moves. I am Vincent Scarsella, Head of Research and Investment Development at Sgroi Lawley. Today, I will be discussing everything that happened in both the stock and the bond market in 2024 and outline key factors to monitor as we begin 2025. The U.S. market delivered impressive returns in 2024, buoyed by strong economic growth, robust corporate earnings, and 100 basis points of interest rate cuts by the Federal Reserve. The S&P 500 completed its best two-year performance since 1997 and 1998, and the gains were legitimate, as we saw near perfect resolution of numerous market unknowns coming into the year. The economy achieved that elusive soft landing as growth was stable but soft enough to allow the Federal Reserve to cut interest rates. Inflation fell back towards the Fed's 2% goal, which further cleared the way for interest rate cuts, and AI optimism remained strong, with surging earnings from technology companies keeping the rise in stock prices at justifiable valuations. Other tangents to the market also remain supportive, as geopolitical shocks never materialized enough to put continued downward pressure on stocks. These favorable conditions propelled the S&P 500 to a total return of just over 25%, with the index recording 57 all-time highs, the fifth highest in a single year since 1928. The tech-heavy NASDAQ led major indices with a stellar gain of 29.6%, followed by the Dow Jones Industrial Average at 15% and the Russell 2000 at 11.5%. A significant share of these gains can be attributed to the Magnificent Seven, which is Tesla, Alphabet, Nvidia, Amazon, Apple, Meta, and Microsoft. These stocks contributed more than half of the S&P 500's 2024 return and now represent nearly one-third of the index's market cap. The concentration highlights potential risks, as these few companies can disproportionately influence market performance up or down. The dominance of the Mag 7, or growth stocks in general, can be viewed in a variety of ways. But if we look at the growth index, as measured by the Russell 1000 index, it rose 33.4% in 2024, while the value index rose a more modest 14.4%, or a 19% dispersion between the two. Those Mag 7 names account for almost 53% of the index. Another way to look at this is to take the S&P 500 against its equally weighted counterpart, which does not weigh stocks based on their market capitalization as the S&P 500 does, but as its name implies, by giving every stock in the S&P the same percentage weighting. As we spoke on, the S&P gained over 25% in 2024, and the Mag 7 contributed more than half of that. The S&P 500's equally weighted counterpart gained 13%, underscoring the outsized impact of the Mag 7. From a broader lens, typically both of the indexes should move in tandem with one another, as you would expect more stocks to contribute to the overall total return. However, since COVID, this dispersion has only grown more and more, with the S&P 500 returning around 243% on a 10-year time frame, or 13.1% annualized. Compare that to a 166% return, or 10.25% annualized for the equally weighted index. Moving to sector performance, it was the more sensitive areas and cyclical stocks that outperformed, while your more defensive names lagged. The communications sector rose 34.7%, financials gained 30.55%, and consumer discretionary rose 26.5%. It was a stark contrast between the gainers and the laggards, as real estate saw a modest 5.1% increase, healthcare rose 2.5%, and materials were flat for 2024, rising 0.14%. Now shifting over to the bond market, many investors came into 2024 very constructive on bonds, as it was believed the Fed was going to cut rates by almost 2% total. This never materialized, as although the Fed did cut interest rates by 1%, it was less than expected, with U.S. economic data remaining strong and the jobs data remaining strong as well. Inflationary pressures also weighed on the bond market, and with all of this, interest rates were volatile, with the 10-year Treasury yield rising by 70 basis points to 4.58%, marking the largest jump since 2022. All in all, the Bloomberg Aggregate Bond Index finished the year up 1.25%. As we begin the first couple of trading days in 2025, January is an important month for a variety of reasons. The positive factors that contributed to the 25% gain in 2024 for the S&P remain intact. We still have all the signs pointing towards that soft landing, the Fed cutting interest rates possibly twice this year, depending on the data, AI optimism, and the belief we will continue to get strong corporate earnings. Next up is the jobs report. This was shared on January 10th, and it matters because it directly can impact rate cut expectations for the year, which are 2 in 2025. With the Fed showing less desire now to cut rates, if the report is really strong, it will reduce expectations for another rate cut and cause yields to rise, affecting both the stock and the bond market. On the other hand, if the report comes in very weak, this could cause a growth scare, meaning markets could start to worry that the US economy is faltering, which would affect corporate earnings and the market as a whole. Next up is earnings season. This began on January 13th, with the big banks kicking things off. The only way valuations for this market are not prohibitive in further gains is if we get substantial growth. If earnings season does offer any warning signs that corporate earnings could be slowing, especially in those Mag 7 and AI names, it could cause some volatility, as investors would think that more and more stocks are overpriced and should be sold. Then we have the consumer price index. The first data point for inflation came out on January 15th. This is very important, as the Fed guided to fewer rate cuts in 2025 because inflation is proving to be stickier than expected. Everyone, including the Fed members, thinks this bounce in inflation is transitory, but we need data to confirm this, and soon in 2025. We would want to see CPI come in either in line with expectations or below expectations, as this would show that we are once again seeing inflation get back towards the Fed's 2% target, and the Fed could stay on track with its planned 2 interest rate cuts this year. If CPI comes in higher or hotter than expected, it would imply inflation is bouncing back, which would further reduce rate cut expectations and send yields higher and stocks probably lower. The last thing is the Fed decision, which happens on January 29th. This is also very important, as the Fed continuing to cut rates, even if it is slowly, is a critical piece of this bull market. And if the Fed hints it may pause cutting rates at this meeting, then this would be a major negative. No one is expecting the Fed to cut interest rates at this meeting. However, investors will want to hear Powell state they are still committed to cutting interest rates in 2025. The fundamentals entering 2025 remain robust, supported by economic stability, AI-driven growth, and supportive monetary policy. However, elevated expectations heighten the risk of disappointment in this environment, and January's key events will set the tone, determining whether we sustain the bullish momentum or face renewed volatility. Thanks for tuning in for this edition of Market Moves. If you do have any questions, please do not hesitate to call Sgroi Lawley.